Welcome to Buy, Hold, Sell. My name is Matthew Kidman, and we start 2018 just like we finished 2017, talking about the Australian barbell share market. Resources on one side, banks on the other. Which one do you play? Which one are you going to make money out in 2018? And to help me talk about this is Chad Slater from Morphic and John Ayub from Wilson Asset Management. Welcome, gentlemen. Johnny, I'll start with you. Real dichotomy between banks and resources. Resources, the renaissance. Banks in the hole, no one wants to know them, a lot of regulation. Let's start with banks, especially the big four. How do you see them at this level?
Well, I think banks this year, there'll be a lot of trading opportunities for the most part. A lot of what carried through in 17 will carry through into 18, so we'll see a lot of regulatory headwinds. Credit growth will continue to slow. We're getting towards the peak of a housing cycle. So for us, there is valuation support with about 6% yield, but it's more of a trading opportunity, more of a sector neutral position for us.
They can't catch a break, can they, the banks? The government's after them. The regulators in general are after them. Chad, so do you think they're a good buy here? They're not expensive historically. And if so, they're a good buy. What's your best pick out of them, the big four?
Well, firstly, we don't think they're a great buy. But we'll start with a stat. If we were sitting here in April 2015, the 1 year forward consensus number for Commonwealth Bank at that point was $5.70. So the market thought it would earn $5.70 on the average over the next 12 months. We're sitting here today, and guess what? They think it's going to earn $5.80, i.e. over 3 years,
no growth.
Nothing. So that's why the stocks have gone nowhere. And look, I can't disagree with some of the points, is that you've got credit headwinds, etc., but you've also got better margins in other areas.
Okay,
nowhere.
Okay, Johnny. Good trading opportunities. Of the big four, what would you trade on the long side?
CBA is probably the pick at the moment. It lost a lot of market cap last year around the regulatory headwinds that it faced and some of the
and a bit of bad behaviour.
Yeah, and a bit of bad behaviour under ASIC breaches. But we are going to the reporting season. They've got the most exposure to the mortgage market, and with the bad debt cycle still very benign, it may change toward the back end of this year, they probably got the most upside of all the banks at the moment.
Okay, let's get on to a bit of global growth, get our hands dirty. Resources, the other side of the barbell. What do we think about resources in general? It's a big area, but especially at the top end, BHP, Rio, Fortescue and even oil. Have you got a positive view on those?
Look, we remain positively disposed to resources. This year is going to be a big year around capital management. The major resource companies are going to print a lot of money. They've been very disciplined on the cost side of their business. There's going to be a continuation of synchronised global growth. China keeps on driving its growth along with pollution control, which will actually bode well for Australian resources. Clearly, we're starting off a higher base, but I think they should do well.
Chad, it's a cyclical business, supply and demand. We've got good demand at the moment, and supply is probably lagging, prices up. We're going to keep getting that in 2018.
I hate to repeat what was just been said over there, but I'll have what he's having. I think it's more of the same. Simply, global GDP correlates very well with earnings and commodities demand. Global GDP, we're coming in the best numbers in 6 years we're starting the year. That should flow through into demand, and as was just mentioned, supply has been really tight. The big question for me in this year is what do they do with their cash flow, which was touched on there. Do they waste it like they did in 12, 13 or 14? Do they return it to shareholders, or do they invest it wisely? That will be the key driver on the stock level. Okay,
we're positive on resources. Give us one tip on the long side.
Look, I'd have to say something like Woodside or one of the oil majors. What's been really interesting in the last 12 months is the oil price has gone up close to almost 50% US dollars, but the stocks just didn't believe it. So what it said was all the equity owners like us were like, nah, it's not going to last, can't last, can't last. But if you look at the forward curve, $60 now, you can see these upgrades coming through now. I think that's probably going to have some momentum, so I'd be in something like that.
Johnny, have you got something similar, or is it iron ore, is it coal, is it oil and gas?
It's hard to disagree, but if I was going to get a little bit more creative, Whitehaven, I think the coal thematic will continue to play out this year, but at the big end of town at Rio Tinto, they're going to keep printing cash and they're going to have a great year.
So, there's one thing for certain, you can bank on resources.